Welcome, this is a rapid-fire review for Principles of Real Estate in Texas 1, built around the questions test takers miss most. No fluff, just the concepts, the vocabulary, and the traps. We'll start with the 5 big patterns behind most wrong answers, then sweep through each unit. Ready? Let's go. Here's the single most valuable trick in this whole video. When a word ends in OR, that person is giving something. When it ends in EE, that person is receiving it. The grant or gives the deed. The grant EE receives it. The mortgage or that's the borrower gives the mortgage as security. The mortgage EE, the lender, receives it. The pay or makes the payments. The pay EE, the lender, receives them. This one rule is behind more wrong answers than almost anything else on the exam. From now on, every time you see one of these words, stop and ask, who is giving something here? The OR gives to the EE. Every single time. 2 documents show up at every Texas closing, and they do completely different jobs. The promissory note is the promise. It says, I owe you this money, and here's how I'll pay it back. Think, I owe, the deed of trust is the or else. It puts the house on the table as the thing the lender can take if the promise gets broken. The note creates the debt. The deed of trust is the security. When a question asks what secures the loan, the answer is never the note. It's the deed of trust. A Texas deed of trust has 3 parties. The borrower, called the trustor, the lender, called the beneficiary, and in the middle, a neutral third party called the trustee who quietly holds legal title until the loan is paid off. Why does the trustee matter so much? Because if the borrower stops paying, the trustee, not a judge, can sell the property at public auction. That's called non-judicial foreclosure, and Texas allows it through the power of sale clause. No courtroom, just rules. 21 days of written notice, posted at the courthouse door, filed with the county clerk, and certified mailed to the debtor. If it's someone's home, they first get 30 days to catch up under Fannie and Freddie documents. Other cases get at least 20. Say it with me. In Texas, the trustee sells, no court needed. FIRPTA is the federal law that makes sure a foreign seller pays U.S. taxes when selling U.S. real estate. And here's the twist everyone forgets. The buyer is the one who must hold back the money and send it to the IRS within 20 days of closing. Not the seller, not the title company. The buyer. To find the rate, ask just 2 questions. 1. Will the buyer live in the property? 2. What's the price? If the buyer will not live there, 15%. No matter the price. If the buyer will live there, under $300,000, 0. Between $300,000 and $1 million, 10%. A $375,000 house? Buyers living there, price is in the middle band, 10%. Live there cheap, free. Live there mid, 10. Everything else, 15. And 1 escape hatch. If the seller signs an affidavit saying I'm not a foreign person, nobody withholds anything. Picture a force field around a Texas family's home. Credit card companies can't get through it. A business partner who wins a lawsuit can't get through it. A relative you owe money to can't get through it. That's Homestead protection, and it's automatic, no application needed. But 9 kinds of debt were built into the force field, and they can absolutely take the house. Here's the pattern that covers all 9. If the debt is about the property itself, it gets through. Property taxes, the loan that bought the house. The contractor who remodeled it, a home equity loan. The HOA, refinances, reverse mortgages, old liens from divorce or death, and converted manufactured home liens. So when a question asks which debt can foreclose on the homestead, ask yourself, is this debt about the house? If yes, it wins. If it's just general money trouble, the force field holds. 2 quick homestead numbers. Urban homestead, up to 10 acres. Rural homestead, up to 200 acres for a family. And 1 signature rule that shows up everywhere. Anything that puts a voluntary lien on a homestead, like a remodeling contract, needs both spouses' signatures. Even if the house belongs to just 1 spouse, even on a listing agreement. Both spouses, always. Every lien can be sorted with 2 questions. First, does it attach to 1 property or everything the person owns? A mortgage, a property tax bill, a contractor's lien, those attach to 1 specific property, so they're specific liens. A court judgment or an income tax lien follows the person and touches everything, those are general liens. Careful. The test loves to say particular or general, the real term is specific. Second question, did the owner volunteer for it like a mortgage, or did the law create it like taxes? That's voluntary versus involuntary. When a property sells, liens do not simply line up by the date they were recorded. Property taxes and special assessments cut to the front of the line, always. Then comes a Texas oddball, the Workforce Commission wage lien, which beats everything except those taxes. Mechanics' liens get their place in line from the day work began, not the day the paperwork was filed. Only after all of that do the remaining liens line up by recording date. 3 dates. January 1st of the tax year, the lien attaches silently, automatically. Around October 1st, the bill arrives because Texas taxes are paid in arrears at the END of the year they cover. January 31st of the next year, last day to pay. Miss it, and on February 1st you're delinquent. Lien on January 1. Delinquent on February 1 of the following year. Test takers mix those 2 dates up in both directions, so picture it as bookends. The lien starts the year, delinquency starts the next one. Texas tax rates are quoted per $100 of value, not per thousand. A $300,000 home taxed at $3 per hundred. 300,000 divided by 100 is 3,000, times 3 is $9,000. And if taxes go unpaid all the way to a tax sale, the winning bidder gets the deed from the sheriff. The old owner can still buy it back, that's redemption. 2 years for a homestead, farm, or mineral interest. 6 months for everything else. These are pure memory, read them out loud twice. A section is 1 square mile, 640 acres. This one gets missed all the time, so once more, a section is 640. A quarter section, 160. A township, 6 miles by 6 miles, 36 sections, and section 16 is the school section. A mile, 5,280 feet. An acre, 43,560 square feet. A chain, 66 feet. A vara, Texas special, 33 1/3 inches. A square yard, 9 square feet. A cubic yard, 27 cubic feet. A square foot, 144 square inches. And a circle, 360 degrees, each degree 60 minutes, each minute 60 seconds. When a legal description stacks fractions, like the north half of the southwest quarter of the southeast quarter, multiply every fraction against 640. Half times a quarter is 1/32. 640 divided by 32, 20 acres. The classic mistake is skipping one fraction and getting 40. Count the fractions, multiply them all. Meets and bounds, the oldest method, going back to when Spain ruled Texas. It walks the property line, distances, directions, boundaries. The rectangular survey system, the grid, was created by Congress in 1785, and here's the Texas twist. Texas doesn't actually use it, except for borrowing the word section. And the recorded subdivision plat, lot and block, is how a normal city house is described. Lot 15, Block 7, Cedar Oaks Edition. If the description has a lot and a block, it's a plat, not meets and bounds. A monument is a boundary marker, usually man-made like an iron pipe, but sometimes natural like a tree, and when they disagree, natural objects and actual measured distance win. That's why deeds say more or less. A benchmark is an elevation marker, like a brass plate on a building, and it's permanent. These things get used for over 100 years. A datum is the level surface elevations measure from, and land is always surveyed as a flat plain. Hills and valleys add nothing. Every proration problem is the same 3 steps on a 360-day year. Step 1, yearly amount divided by 12 gives the month, divide by 30 gives the day. Step 2, decide who owns which days. The seller owns every day up to and including closing day. Step 3, multiply and add, and keep the pennies until the very end. Taxes of $4,383.55, that's $365.29.5 a month, $1217.5 a day. Closing June 15th means the seller owes 5 months plus 15 days, $2,009.12. The buyer's side is its OWN math for its own dates, never reuse the seller's number. And interest, $165,000 at 3% is $1375 a day, 16 days is $220. Loan payoff, balance plus the exact accrued interest, $98,025.67. Don't round until you're done. Now slow way down because this next one catches almost everybody, and it usually catches them with the exact same wrong answer. The question, how much does the buyer owe in prepaid taxes from June 16th through July 31st? The tempting answer is $2,009.12. Here's the problem. That's the seller's number, the one you just calculated on the previous question. Exams love to put two proration questions back to back, hoping your brain will reuse the number it just worked for, and it usually does. So here's the picture that fixes it forever. The closing date is a border. Everything from January 1st through closing day, June 15th, is seller territory. Everything after June 16th onward is buyer territory. Each side gets its own math from its own days. They can never share a number. Now walk the buyer's side slowly. Yearly taxes, $4,383.55. Divide by 12, $365.29.5 a month. Divide by 30, $12.17.5 a day. The buyer's stretch, June 16th through June 30th, 15 days, plus all of July, 1 month. 15 days times 1217.5 is $182.64. Add 1 month, $365.29. Total, $547.94. And here's your built-in alarm bell. The buyer's stretch is a month and a half. The seller's was 5.5 months, so the buyer's number must be way smaller. If your two proration answers ever come out identical, one of them is stolen. Say the rule. Seller pays through closing day, buyer owns every day after, and each side does its own math. 4 traps catch test takers over and over. Trap 1, the word not, which is not required. It's so easy to pick the thing that is required. Circle the not. Trap 2, the swap. A sentence that sounds right but two sibling words are switched, possession for exclusion, physical for economic, remainder for reversion, erosion for avulsion. If a true-false statement defines a term, ask, is this word's definition or its twins? Trap 3, the neighbor number, 1929 versus 1939. 15 days versus 21. When the answer is a number, the wrong choice is live next door, slow down. Trap 4, absolute words. All, only, always, never. In a true-false question, absolutes are usually the lie. Physical characteristics are what land is: immobile, indestructible, and non-homogeneous, no two parcels alike. Economic characteristics are what make it worth something: scarcity, improvements, permanence of investment, and area preference, also called situs. So landscaping a property? That's an improvement, economic, and the word situs means people prefer a location, not landscaping. Legislatures, Congress and state legislatures, write statutes, and both levels can also create enforcement agencies. The Texas Real Estate License Act is a state statute, written by the legislature, not by an agency. Agencies like TREC write regulations, and those regulations carry the full effect of LAW. Court decisions in one jurisdiction have no automatic effect on other jurisdictions. And when a developer wants to build, approval comes from local government, zoning, and planning boards. One date to lock in: the first Texas brokerage law was 1939. The current one, TRELA, 1949. The broker is the one who legally represents the buyer or seller. A sales agent works for the broker, on the broker's behalf. And property classification follows current use. An old shopping center reborn as senior apartments is residential. A mansion split into condos is still residential. Residential means all housing, city lot to acreage, one family or many. Owning real property is owning a bundle of 5 rights. Possession, you hold it. Enjoyment, you use it any legal way you like. Disposition, you can sell it or give it away. Control, you decide how it's used. And exclusion, you keep people out. The two everyone mixes: telling neighbors they can't cut through your yard or removing squatters, that's exclusion. And use it in any legal manner, that's enjoyment. When something's attached to a house, courts run 3 tests. Intent: did the person mean for it to stay? That not included sign on the stove is intent in action. Adaptation: was it custom made for this space? And annexation, the method of attachment: would removing it cause damage? Tack down carpet fails that one, so it stays. A bookcase deliberately left unattached? The annexation test says personal property, it goes. Plants: things that grow naturally are real property. Annual crops are personal. And a business tenant's shop gear, shelves, bars, equipment, those are trade fixtures. The tenant's personal property, out by lease end, or the landlord keeps them. Land comes in layers: surface, subsurface, air, and splitting them is called lateral severance. Texas quirks: underground water belongs to the surface estate. Subsurface rights cover natural resources only, drill up buried gold artifacts and they are not yours. Strip mining wrecks the surface, so it counts as a surface right. Want to build over railroad tracks? Buy the AIR rights. And when an airport lands next to an existing neighborhood, homeowners can demand soundproofing or even a buyout. Land along a river carries riparian rights. That's true for Texas land granted before July of 1895. Everything after runs on prior appropriation. Show a beneficial use like irrigating crops and get a permit from TCEQ. But the permit does not include a path across your neighbor's land. Easements come from the owner. Groundwater runs on the rule of capture. Pump as much as you choose, just no malice, no waste. Border a non-navigable stream and you own to the center of it. And when a flood suddenly rips land away, that's avulsion and boundaries don't move. Slow erosion, that land is gone for good. A life estate that passes to a third person at death is a remainder. If it snaps back to the original owner or their heirs, it's a reversion, reverts, returns. The feudal system means the king owns everything. America runs allodial private ownership. Deed restrictions are private rules from developers, not government. A personal easement in gross dies with its holder and can't be handed off. A writ of execution comes after a judgment, and bankruptcy does not erase a mortgage. Other debts may vanish, but the lender can still foreclose. When a deed shows two owners and doesn't say how Texas assumes tenancy in common, no survivorship, your share goes to your heirs. Joint tenancy, where the surviving owner scoops up your share, even over your will, must be spelled out in writing. Either way, any co-owner can sell their own slice without asking. Married couples, everything bought during marriage is community property. Separate property is what you brought in, inherited, were gifted, or bought with separate funds, but watch it. The income from separate property becomes community. Spouse dies without a will. If all the kids belong to both spouses, the survivor gets all the community property. If there are stepchildren, the survivor keeps half, and the other half goes to the deceased's kids. And severally, despite the sound, it means one owner severed from everyone else. A sole proprietorship is one person, full control and full personal liability. Creditors can raid the personal checking account. It files an assumed name certificate with the county clerk, tells TREC within 30 days of adopting a business name, and never registers with the Secretary of State. A corporation flips it. Shareholders can lose only what they invested. Their stock is personal property. But profits get taxed twice unless it's an S-corp. TREC rules for a brokerage entity. A designated broker with an active Texas license, a broker's license in the company name, and E&O insurance if that designated broker owns less than 10%. Bylaws on file at TREC. Not a thing. And the revocable living trust is the will substitute you can change anytime. In a condo, you fully own only the airspace of your unit. Everything else, even the balcony that serves only you, is owned pro rata with the neighbors. In a co-op, a corporation owns the building. You own shares, personal property, plus a proprietary lease to your unit. A timeshare is usually a FEE simple interest, no expiration date, and a buyer who didn't get their contract copy can cancel before the 6th day after receiving it. 3 formulas, 30 seconds. Adjusted basis, what you paid plus improvements minus depreciation. Capital gain, NET selling price, that's price minus selling costs minus that adjusted basis. Jennifer's rental, $300,000 minus $21,500 in costs is $278,500. Basis, $200,000 plus $18,000 in improvements minus $20,000 depreciation, $198,000. Gain, $80,500. Cash flow, income minus expenses, $100,000 in, $110,000 out is negative $10,000, not a gain. Borrowing most of the price is leverage, power, and risk together. Interest, dividends, and royalties are portfolio income. The $25,000 rental loss allowance starts phasing out at $100,000 of income. A tax credit beats a deduction. And a rate skips corporate tax by paying out 90% of its income to shareholders each year. Both sides promise. Bilateral, that's every ordinary sale, even a handshake-sounding Jerry agrees to buy Mark's farm. Only one side promises. Unilateral, like an option where the seller must sell but the buyer is free to walk. signed but not yet closed, executory, fully performed, closed and funded, executed, an illegal purpose, a marijuana farm, a meth lab house, the contract is void. Dead on arrival, no matter what the parties want. A minor's deal, voidable, the minor can undo it at 18. An oral listing, unenforceable, it might be a real agreement, but no court will make anyone pay a commission on it. Consideration, the exchange of promises, is what makes a contract valid. Earnest money is not required. It's a good faith deposit held by a neutral escrow agent, and a broker must bank it by the end of the second working day. One escrow account for all deposits is fine. The termination option. The buyer pays the option fee within 3 days of the effective date, 3, not 2, and during the option period the buyer can walk for any reason. Walk, and the option FEE stays with the seller, but the earnest money comes back. During the option period, the buyer can even ask for repairs on an as-is deal, but the clock never pauses, and it always runs from the effective date. Breach of contract, you've got 4 years to sue. Seller refuses to close, a specific performance suit can force the sale. TREC forms, promulgated means must use, approved means may use. There is no promulgated contract for deed form. Both sides need lawyers, and jury-rigging the standard forms into one can cost an agent their license. Home inspections, only a Texas licensed inspector, and yes, the seller is allowed to attend. It's still their house. Lead paint disclosures, skip elderly housing, short leases, studios with 0 bedrooms, and foreclosures. Mold remediation certificates travel with the house for 5 years. An exclusive agency means the seller can still sell it themselves and pay no commission. That's exactly what makes it different from exclusive right to sell. A deed transfers property while you're alive. A will does it at death. A valid Texas deed needs both parties named, consideration, a good description, words of conveyance, the grantor signature, a power of attorney agent can sign, and delivery plus acceptance. The 5 warranty deed covenants as 5 promises. Sason, I own it. Against encumbrances, no hidden liens, forget to mention the mortgage, and this is the broken promise. Quiet enjoyment, no one will out-title you. Further assurance, I'll sign whatever fixes it. Warranty forever, if title ever fails, I pay. Forever means forever, not 99 years. Oh, and a bargain and sale deed is Texas's deed without warranty. A deed in trust moves property into a trust. A deed of trust secures a loan. Die with a will, testate property passes by devise. Die without one, intestate property passes by descent, split among heirs by state formula. Probate happens in the county where the deceased lived, not where the land sits. And a broker selling property out of probate, the judge sets the commission. One more, a will cannot give away the surviving spouse's own half of the community property. That half was never the deceased's to give. Title can move without the owner's consent. Escheat, eminent domain, foreclosure, and adverse possession, which many people get exactly backwards. It doesn't protect the absent owner. It lets a squatter with a claim take title if their possession is open, notorious, hostile, and uninterrupted for the statutory period, 3, 5, 10, or 25 years in Texas. The 25-year version requires good faith and a recorded deed. The point isn't stealing land. It's forcing old boundary disputes to finally get settled. Here's a chain that produces wrong answers 6 different ways. A deed, even a general warranty deed, proves nothing about the condition of title. Real evidence comes 2 ways. Path 1, an abstractor compiles the property's full paper trail, the abstract guaranteeing nothing, though they can be sued for sloppy work. Then the buyer's attorney reads it and writes an opinion of title. An opinion, not insurance. Path 2, title insurance. Within 20 days, the title company issues a commitment, the promise to insure, and the actual policy arrives at closing. If a covered claim hits, the insurer pays, and then subrogation kicks in. The company inherits your legal rights and goes after whoever caused the loss. Subrogation trips people up constantly. It just means they paid, so they get to do the suing. Recorded documents give the world constructive notice. The law assumes you checked. So does someone physically living on the property. Even if their deed was never recorded, you're expected to knock and ask. Actually reading the records yourself? That's actual notice, direct knowledge. And the history flashcards. Spain brought metes and bounds. Mexico granted leagues, squares 5,000 varas on a side. The Republic and State of Texas issued surveys. 640 acres each, tracked by abstract numbers at the General Land Office. The borrower's promises inside a deed of trust: pay the note, pay the taxes, keep insurance, maintain the place, and no hazardous materials. Buying a house subject to its old loan means you are not personally on the hook, but assume that loan and you are fully, with the original borrower still liable too, unless the lender releases them. A landlord in foreclosure keeps collecting rent until the sale. And the mercy menu: forbearance pauses payments for someone with a verifiable income hit. Modification rewrites the terms. Forgiveness, the only one that erases debt, means the lender writes principal off and walks away from it. A short sale happens because the seller is underwater and can't keep up the payments, not because a foreclosure already happened. This one deserves its own slide because it may be the most missed clause question on the exam. Almost everyone picks acceleration clause. The question: if the borrowers decide to pay off their mortgage early, what clause may affect that? The answer is the prepayment penalty clause. Here's why the wrong answer feels right. Both clauses end with the whole loan being paid off ahead of schedule. But the difference, and the only thing being tested, is who makes it happen and why. Prepayment penalty: the borrower is the hero. They came into money, they're paying the loan off early by choice. The lender, counting on years of future interest, charges a fee as a consolation prize. Good news story, small fee attached. Acceleration: the borrower is in trouble, they stopped paying. The lender slams the gas pedal and declares every future payment due right now. That's the step that opens the door to foreclosure. Bad news story: lender pulls the trigger. So, who's happy? Borrower happy and paying early, prepayment penalty. Lender furious and demanding it all, acceleration, or just match the words. The question says pay early, early payment is PRE payment. Round out the family: borrower sells the house, that's the DUE on sale clause. Default already happened and the trustee auctions the property, that's the power of sale. One more time: pays early, prepayment penalty. Stops paying, acceleration. Sells, due on sale. Lock those three in and this question is permanently dead. RESPA is a federal law from 1974 with one mission: protect consumers from abusive lending practices by making closing costs honest and visible. It covers federally related residential mortgage loans, and not business, commercial, or agricultural loans, 25+ acres, construction loans, vacant land. Under RESPA, the seller can never force the buyer to use a particular title company. And when one settlement provider refers you to another company it partly owns, you must get the AFBA disclosure, affiliated business arrangement, at or before the referral. Who brings what? The buyer shows up with the hazard and flood insurance, the cash to close, and the loan documents. The closing agent runs the show. The sales agent is there to answer questions and chase missing paperwork. Helpful, not essential. The IRS 1099-S goes out from the closing agent, or if not, the lender, or if not, the broker. And say it one last time: Texas property taxes are paid in arrears and prorated through the closing date. That's every high-miss concept patched and reinforced, including double-length treatment of the two that trip people up every single time: the buyer-side proration and prepayment versus acceleration. Those two can now be your strongest material because you know exactly how they trick you. Before your exam, reread the big patterns. Or gives to note versus deed of trust, the FIRPTA grid, the Homestead 9, Lien priority, the measurement table, and the proration recipe. Slow down on not questions, watch for swapped twins, and double-check every number against its sneaky neighbor. Make the knowledge stick, and go get it.